Good morning. Welcome to this morning's CBI coronavirus webinar. My name is Kerry Thomas. I'm an editor at a new startup called Tortoise, and it's a great pleasure every day to be doing these things with the CBI. But particularly today, some days when you get to speak to people who are not always accessible in real life. It's part of the Bank of England's job to be a little bit difficult to get hold of. So it's a great pleasure to have with us today Alex Brazier, who's Executive Director for Financial Stability, Strategy and Risk at the Bank of England, as well, of course, as Ray Newton-Smith, who's the CBI's Chief Economist. I'll come to both of you in a second, but regulars on this call will know the score, but let me just run through it briefly anyway. It's really about getting as many questions or comments in from you as we can possibly get. That's what drives this thing along, and that's what helps the CBI understand the mood and the questions that are arising out there, and to feed those things through to government. So it helps in a whole bunch of ways. We'll get through as many questions as we can or comments as we can in the next 45 minutes. But those that we don't, the CBI has a team of Stakhanovite researchers who get through the rest in the course of the day or as soon as they can. And I know they're getting through a large number every day, so they will try to come back to you if we don't manage to come to your question live in this call. If you want to submit a question or a comment anonymously, then the way to do that is just to write anon at as the first thing we see in the question, and we will respect that, of course. There is just one other way that you can get through to the CBI, which is direct by email: coronavirussupport@cbi.org.uk. Coronavirus support, all one word, cbi.org.uk. And if you weren't able to join yesterday's call about the impact of coronavirus and the lockdown on companies' approach to digital, then you will find that along with all the other back catalogue of webinars on the actually rather brilliant CBI Coronavirus Hub, which you'll find on the main CBI website. Enough of the throat clearing and the housekeeping. Let's start, as we always do, with the sort of big picture. So, Rain, since we're talking about Bank of England support measures and also some bigger economic questions, we've seen over the last couple of weeks a range of forecasts, quite a wide range, forecasts and scenarios about the current prospects for recovery. What's yours and the CBI's central understanding at the moment of what the picture looks like?
Yeah, well, look, Kerry, and good morning, everyone. I mean, every week it just feels like another unprecedented moment, and I think one of the things that stood out for me this week is, seeing the first time ever that US oil prices went negative. I certainly didn't expect to see that in my lifetime. And really, it just reflects the scale of what we're seeing at the moment. We know that over 60% of the world economy is now in some form of lockdown. And because that economic activity means in so many sectors that's ground to a halt, we know that. I know it firsthand from talking to so many of the businesses that we're talking to daily. And what that's meant for the oil market is that demand for oil has obviously dropped through the floor, and of course the way the oil market works is people buy things on forward contracts. So some people in the US have bought them on forward contracts, and now the cost of storing that oil is actually more than they can sell that oil for, and it just illustrates some of the challenges that are out there. And of course here closer to home in the UK, while Brent oil prices aren't quite as low as that, hovering around $20, hugely challenging for the North Sea, where the costs of production are much higher than that. So it just continues to be unprecedented times. And I think one of the things as we look to the recovery as well is just thinking what that means for our wider economy, what it also means about the move to a low carbon economy and the environment, which we want to be at the heart of the recovery. And it may also mean that there's a window of opportunity to think about things like the carbon price and some of the policies we may need to see in that move to a low carbon economy, and how we accelerate the uptake of renewable forms of energy. But I think, look, Kerry, returning to your question in terms of what we're seeing, there's no doubt this is the deepest downturn, I think, the UK will experience in the short term. The Office for Budget Responsibility last week talked about growth in Q2, the current quarter, falling by 35%. I think on the basis of what we're seeing from our surveys and the conversations we're having, and just the extent of how many businesses have closed their doors, that does feel in the right sort of ballpark. Of course, the key question is how we recover from that. And I think even just 10 days ago, on this webinar, I was talking about, V-shaped recovery. I think from what we're seeing now and how it's playing out in a lot of economies, I think it is going to be a more gradual recovery. You can think of it maybe as a sort of Nike swoosh. It's going to be a bit longer before we come out to that recovery phase, but we will get there. And of course, how quickly we get there depends on the measures and the support that have been put in place. And it's also hugely challenging for policymakers who are looking at, how much longer do we need to be in this lockdown phase? And importantly, when we come out, how much longer do we keep some measures of social distancing, and what are the roles of businesses in helping to open up, but at the same time protecting the health of citizens? And there's pretty stark choices. I mean, the Resolution Foundation were looking at the scenarios, if we have an extreme lockdown that continues for 3 months, then we could see the impact on unemployment rising above 6% possibly by the end of the year. But if we see a lockdown, and that's a very extreme lockdown that continues for a year, you could see unemployment of 20%, which would be hugely unprecedented. But I think if you look at the sort of consensus on growth for this year and next year, most people are viewing, you'll see the UK economy shrink by maybe 6% this year, but then you'll see a recovery next year of around 5%. Huge uncertainty around those figures. And I think for me, there's 3 main channels which will determine what that recovery looks like. And the first is about how, you and I, how we all behave as we come out of this. We know that from the ONS that about 3/4 of households have seen their income lowered as a result of this crisis. So there's a big question: what happens when we come out? Do we feel confident? Do we want to go out and spend? Are we in a position to spend money? Do we want to go to hotels? Do we want to travel? Or are we worried? Do we end up quite concerned about what might happen, and therefore fearful, and decide to just keep shoring up savings? That consumer behavior is so important. The second big factor is absolutely about what happens to jobs and unemployment, and it's why that job retention scheme has been so vital to UK businesses and to households. And the reason is, and look, Alex and others, we've got experience of what previous recessions look like. And actually, one of the things about the global financial crisis is actually it didn't have quite an impact on unemployment as people expected. It played out in a longer hit to productivity. But I think there's a concern, certainly in some countries, that unemployment could really skyrocket. And I'm just about old enough to remember the early 80s in my dim and distant memories, and the impact that increase in unemployment had on the young and the old, and how devastating that was for our northern communities, where we saw the miners' strike and that really harrowing recession. And so the idea behind the job retention scheme is to help support companies to keep businesses in employment as we move through this crisis. And there's been a huge amount of applications so far. All credit to the Treasury and HMRC to getting that system up and running. From Monday, they've had over 300,000 applications and counting already. We know it's saved over 2.2 million jobs already, and my sense is actually the number is a lot higher. So that is really important. And one of the questions as well as we come out of that is how do we move away from the job retention scheme? We certainly hope in 6 months' time we'll be recovering and we won't need that same level of support. And that's where some of the questions we get from the webinar are, can I partially furlough? And I think that it hasn't been possible to do that yet. The focus has been on getting the current scheme up and running. That's what we needed. But as we come out, I think there's a big question about, can we use some of these schemes part-time? What does it look like across different sectors? Some sectors are going to need that job retention scheme for longer, and others can probably manage without it sooner. So that's one of the big questions for how this unfolds. And then I think the third thing, of course, is not just about jobs, it's about companies, and how many companies make it through this crisis, and how many see light at the end of the tunnel. And that's something we are hugely focused on, and it does come back absolutely to cash flow. That's what businesses are telling us, and that's where the role for the Bank of England is so important, and the role of the CBIL scheme, the business interruption loan scheme, which is provided through the banking system, also plays a huge role. And I think the only other thing I'd sort of highlight on the cash flow point before we open up is also the role of grants. So actually there was some good news on that. One of the ways in which government has been supporting particularly small businesses is you can get a grant through your local authority if you're in the retail, leisure or hospitality sector, essentially our high street shops. And as of yesterday, £6 billion had been dispersed by local authorities to small businesses. Now, one of the things that we knew would happen is there's huge variation in the councils who are doing this really well and others who are maybe struggling. And some of that, of course, is about staff shortages. So the champions we have at the moment are Winchester, Redcar and Cleveland, who have seen 98% of their grants went out the door already. But then we have some actually quite close to where I live. So Birmingham, Slough, and South Oxfordshire have only managed to get around 11% of those grants out the door. So one of the things we're really looking at is, how do we support the local authorities to get the money out quickly to the people who need them? And I think that's something we should all have our eye on. And of course, it then opens up to this wider point about how can people get loans and other things to help them through this crisis. So really looking forward to how we discuss that this morning.
Great, thank you, Rain. Thank you, and great to have an update on how some of those important schemes are working. I'll come back to you in a second because I think you might have some news on the CBILS scheme as well. But before I do that, Alex, let me come to you, because the schemes that that Rain has mentioned have obviously had a great deal of publicity. There's been an awful lot of coverage of JRS, CBILS, and so on. The Bank of England schemes, because they're different, bigger, don't touch as many people, perhaps have had less attention. So could you start by just giving us a rundown on what the bank has been doing, what the schemes are you operating, and the thinking behind them? Alex, I think we have to stop you because I can't hear Alex.
Headset. Oh, I've been unmuted now by the organisers. Thank you for that. Well, good morning, everyone, and thanks for joining. I hope everybody's staying safe and well in this lockdown, and thanks for having me on the webinar this morning. I'll say a little bit about the Bank of England schemes, but they all slot into the broader context that Rain was describing. And obviously, the front line of this crisis, unlike the last one, is the public health response and the response of key workers. So the financial authorities here are very much playing a supporting role in this. And I think the important role that the bank, the Treasury and others can play is actually in, to go to Rain's point, in ensuring that whatever shape this is, a Nike swoosh, a V, a U, a W, whatever shape it is, that when we come out of it, the level of output and activity in the economy is as close to where it would have been. The long-term scars from this are as light as we can possibly make them. And that's the kind of overarching principle that's guiding the response of the financial authorities. Now, of course, as Rain says, the level of output in the second quarter and probably further out is going to be very heavily influenced. That should be no surprise to anyone. When you lock down a large swathe of an economy, you will get historically unprecedented falls in output. But this isn't the bursting of a bubble or the turning of a boom. So companies that were viable going into this, to a very large extent, should be viable coming out of it as well. And that's why the key job here is to try and prevent unnecessary scarring. And the way we're trying to go about that is to kind of build a bridge across the reduction in economic activity. Many companies, many people listening to this will have experienced sharp falls in turnover. the important thing, as Rain says, is that as far as possible, employment and capital and businesses themselves can actually be maintained through all this. So a key part of the response to that has obviously been, as Rain says, fiscal policy. We've seen unprecedented, rapid, powerful fiscal action. You look at the Office of Budget Responsibilities projections, they're looking at a 220 billion increase in the fiscal deficit in the second quarter. That's an extremely powerful response, and a large part of that will be obviously important measures like the job retention scheme. And that's really the main part of the response. But that will still leave a cash flow need for the corporate sector overall. And however you look at it, the banking system will have to play a major role in providing that credit. It's the infrastructure that normally provides credit to the economy, so it's actually the most effective and efficient way to provide credit. And really, the response has been centered around that. And let me explain how. The first thing has been that the Bank of England has opened a term funding scheme, which straight off gives banks £100 billion of funding, and then matches, and in some cases more than matches, any new loans they make in terms of funding they get. So funding is dealt with for banks. The second thing is that over the past 10 years, we've built up very big buffers of capital in banks that can be deployed when they need to take losses and when they need to expand lending. It was, to coin a phrase, prudence with a purpose. We've had the prudence, now's time to meet the purpose. And we released in early March, which feels like to most of us 3 or 4 years ago, an element of those capital buffers. We released 23 billion of capital. Banks then held back dividends. That's another 7.5 billion. That's enough to support £250 billion worth of lending by the banking system. We've then launched, and we'll come on to talk about this in more detail, the COVID Corporate Financing Facility, the CCFF. We're not very good at naming things, but we're good at running them. The purpose of that, as we'll come on to, is to lend to investment grade big companies to take some of the pressure off the banking system from what was in the early weeks a big drawing down of committed credit lines from banks. And that was sort of eating up banks' capacity. By freeing up that capacity, we've still got this £250 billion. And then on top of that, the government has stepped in and said it will guarantee for large companies and small companies 80% of new lending by banks. So it's effectively leveraging up banks' capacity to lend 5 times over. And that, so we've got to £1.25 trillion worth of lending capacity there. And whatever shape that is, that's way more than the corporate sector needs once you account for the fiscal measures that are put in place. And so banks can this time round be part of the solution rather than part of the problem, and all the measures that are put in place all enable that to happen. And that's where that's the kind of common theme that fits together. But it's very important, therefore, that the banks, and I think they are doing this and they do realize this, kind of lean into this crisis rather than step back from it. They've got the capital, they've got the funding, they've got the state guarantees. If they lean into it and lend, we can get through this. And actually that helps the economy, and by association it helps the banks themselves. If they try and sort of crouch in a defensive position, they will end up harming the economy and by association taking bigger losses for themselves. So they have to get on the front foot and lean in and lend in this. And to some extent, I think they are now, and ramping things up very rapidly.
Okay, let me pick up on that point, because I was interested to know what the Bank of England's role is, or what its influence can be if banks aren't leaning in sufficiently. And obviously, there have been some concerns that that banks have been pushing companies towards commercial loans rather than the 80% government backed. What can you do if you think they're not leaning in sufficiently?
Well, of course, these are commercial organizations, so there are limits, but I think we have put in place every condition needed. We've put in place, as I say, a very generous funding scheme that gives banks 4 years of funding for any loan they make, and gives them £100 billion of funding out of the gate, and they're now drawing that down. We've had over 10 years been putting the capital in place, and for the past 10 years, lots of banks have been complaining about bank capital requirements. Now's the time to actually put them to use. And the third thing is we've now got the state guarantees in place and the other facilities that we'll talk more about. All of those things mean that, frankly, there isn't much reason not to lend here. But of course, there are limits. We are not a command and control economy. We can't direct lending. And indeed, one of the reasons for wanting the banks to be part of this is because they have the infrastructure, the knowledge, the relationships to actually work with corporates to give them what they need to get through this.
Yeah. Okay. Ray, let me come back to you on CBILS. Actually, we've had a comment in, not a question, but a comment, quite an encouraging one. I applied for a CBILS loan through Barclays, and following some searching but fair questions, my loan application went in last Friday. It was agreed yesterday and paid to my account last night. It's a substantial amount of money, and I haven't even signed the paperwork yet. The system is working! Exclamation mark, says Rob Lloyd. Right. Sounds like good news.
Yeah. No, look, and I think in these challenging times, we all need to hold on to those good news stories. And look, I think on the CBILS, and that's a prime example of someone who's gone to their bank, applied for a business interruption loan, and managed to get that through. And our sense is, look, the banks are facing huge operational challenges. They've got staff who are off sick. They're working from home in an unprecedented way, like so many of us. And I think what we're now seeing is the system is starting to work and kick in. And so, we've just had hot off the press the new figures about the overall number of loans, of these business interruption loans that are going out. The banks have now lent over 2.8 billion to SMEs through this scheme. That's an increase of almost 1.5 billion just over the past week. There's been over 36,000 formal applications, and of that, over 16,000 have been approved already, and obviously more in the system and should be being approved daily. So, and I think our sense from talking to businesses and banks very recently is actually for loans over 25k. So these are loans for larger businesses, the medium-sized businesses, that the approval rate is working now. And there were issues at the beginning about banks feeling like they had to offer loans on commercial terms. The banks have worked with the Treasury on clarifying some of the qualifying criteria. They can offer these CBILS right away, and that's really helped to speed things up. But I think where there are still some challenges, and it's partly because smaller businesses, they're not used to filling out loan applications. They often operate just by borrowing from family or friends to keep their businesses in operation. It's loans under 25,000, the really small businesses, where it's just harder to get the volume out as quickly as we need. And I think that's something we're looking at. We know the Treasury are looking at, UK Finance and the banks are very much thinking about it. And I think on that, it's something we really need to watch this space over the coming days. And that may be one area where we need to see some improvements. But the other message I would say is, if you are a small business, do get in touch with your banks. Don't give up. Apply for these loans because the system is improving daily. And if you are still having trouble, get in touch with us and we can help to direct you to where help can be found.
Okay, because as night follows day, of course, my assertion of a positive story about banks has led to a flood of negative comments coming in on the questions. So someone has written in that his or her experiences that the banks are not being supportive on CBILS. We have a viable business that has lost all its revenue, but Barclays has refused CBILS because of some balance sheet nuance. And Alex, a question for you from somebody anonymous. If we are having real difficulties with our banks showing the appetite to support, what is the best way to raise our concerns with the Bank of England? We use major UK banks and they are looking for excuses not to help in this person's experience.
Okay, that's a very good point. And we've taken lots of calls about people's difficulties dealing with their banks in some cases, although I would say, and I would echo Rain's remarks about the pace with which the banks have picked up. Remember, they started CBILS from a standing start almost, and the processing of applications has grown exponentially in recent weeks. So some of this has been inevitable and timing, and difficult operational circumstances, frankly. I think, though, if people want to sort of report their experiences so that we can try and spot any common trends, I would say two things. One is that the Bank of England has a network of agencies across the UK. You'll find details of those on our website. Please do get in touch with your agency from the Bank of England. They are our eyes and ears around the United Kingdom, and there's never been a more important time for having those eyes and ears. Look on our website for details. There's also the public inquiries line at the Bank of England, which can be used for people to just register experiences. There's an email address on the website. It may be that we can't do anything about individual cases, but it is useful for us to be able to monitor people's experiences.
Okay, thank you. While I'm with you, Alex, a specific question on CCFF. How can firms prove, sorry, I've just lost it. How can firms prove they're eligible for CCFF if they don't have an external credit rating, is the question.
Yeah, that's a very good question. And I will take that. Just one bit of context on CCFF before we delve in, which is that this is a scheme authorised by the Treasury, and that's right and proper. We're lending billions of pounds of public money, unsecured, so it's entirely right that elected people take those decisions rather than unelected ones like me. And so the Chancellor sets the risk appetite for this scheme. The Treasury has set that at investment grade firms, and that we think that's a population of about 400 of the largest companies in Britain, accounting for about 25% of turnover in the economy. So the numbers can be pretty big, hence why the Treasury's had to be quite careful about the risk tolerance in this scheme. And we are lending unsecured up to a limit of hundreds of millions of pounds, in some cases £1 billion, with very few questions asked. And I think the quid pro quo of that is that you have to have a certain credit standing in order to be in. Now, that doesn't mean the scheme fails to help other companies, because in taking the pressure off banks of these extremely big and creditworthy companies, we can actually free up some of that space in banks to lend to other companies, which is now being multiplied by the CL bill scheme, the large business interruption loan scheme. So it directly helps investment grade companies, but indirectly helps others as well. But the key challenge, and this was something that Rain was on my case about in the very early stages of the design phase of the scheme, and rightly so actually, is how can a company prove that it is investment grade? Now, the obvious way is you have a public rating. And so people who have that to start with, their eligibility is sorted. But for people who don't, and there are very many companies amongst those 400 who don't, because they've never needed to borrow in capital markets, there are two ways to go about it now. And we've been evolving our approach. We evolved it even before the scheme was launched, thanks to feedback from the CBI and others. So the first way people can approach it is to come to us. There's a very short form on our website to fill in, an eligibility request. And we will try and see if we can convince ourselves with the data we have that the company is equivalent to having a public investment grade rating. And the way we do that is that we have a database of all lending banks' internal ratings of companies they deal with. So we can check pretty quickly whether a company is fairly consistently rated as investment grade. And if it is, we're very happy then to judge companies as investment grade, and they're in the scheme, or they can be in the scheme. Sometimes, though, things are marginal and not quite so clear cut. And in those cases, we're very keen to make sure that everybody who can get over the line does get over the line. And so we may come back to you and ask for more information from your banks via you. And in doing so, try and build up a picture of whether we can meet the kind of risk criteria that have been set by the Treasury. Now, if we can't get ourselves over the line that way, there is a second route available to companies, which is to go to a rating agency, and the list and the details is on our website, and ask for a private rating that can be passed to us. All the rating agencies now are set up to do this. We're seeing an increasing number of letters coming in saying company X is, in our opinion, investment grade, and that's sufficient for us to let them into the scheme. And I should say, finally, that if we can't get you over the line in the first method, it doesn't mean you're ruled out of the second method. So we encourage people to not to give up hope if they are a marginal case. There are a number of ways in which we can get people over the line.
Okay, that's well, encouraging that there are at least plenty of avenues if if the first one is blocked for whatever reason. We've had a couple of questions in on a kind of short-term, longer-term metric. People saying that our banks won't support us for 2021 until they see more certainty around the impacts. But we need to cure this now. Ray, let me come to you with that one first of all. How can that be resolved?
Yeah, one of the things we're constantly looking for is and talking to policymakers in real time is sort of where are the gaps in the policies that have been put out at the moment, and where are some of the policies maybe not working so well. And actually we've got lots of stories of companies who often supply into the retail sector or into some sectors that have had to close their doors. And you can imagine if you're a seasonal, you make swimwear, right? Your big season to sell is right now. You don't really get another opportunity for that until next year. No one wants to buy a swimsuit unless you're like me and a keen swimmer and swim all year round in October. And one of the challenges for those companies is when you can get a loan for a year, but if you then that's interest free and you don't have to pay the recapital for the first year, but at some stage you're going to have to start to need to repay that capital. And if that starts kicking in Q1 next year, just when you're not really sure how open all these stores are going to be, what your revenue is going to be, the viability assessment that banks have to do is particularly challenging. And I think one of the solutions for that is to look at the term repayment for some of the loans. And that has to adhere to state aid rules, but actually those have been flexed. So there's a possibility of extending, we think, and this would have to be the Treasury who made this decision, extending the repayment from 6 years to 10 years. And for medium-sized businesses, having a bit more breathing space could help with some of that viability assessment. And then I think it also comes back to this idea that at the lower end, if you're a very small business, maybe we do and ultimately we have to recognize if the Treasury is taking more risk, that's you and I taking more risk through our future taxes. But maybe it's worth us taking more risk at the very small end to save as many small businesses almost automatically. And that means some of those small businesses will fail and we'll have to pick up the tab for that. But it might well be worth doing that to get as many businesses through the other side, so that we have a viable economy. And that's where having something that maybe has 100% government guarantee at the low end is something that could well be worth considering, just to get the system working as well as we can for small businesses.
Yeah, okay. I'll stay with you, Ren, if I can. So there's an interesting question that's come in, again, looking a little bit further ahead. On a question of cash flow and supply chain, someone writing in to say that, is there any potential that government will provide funding to enable cash to flow through the supply chain so businesses can start up from standstill as quickly as possible? My members, I don't know who this is, are all being told that their outstanding invoices will not be paid until their customers are cash positive. This obviously puts a huge delay and strain into a supply chain. Any thoughts on that?
I think just sort of two things. It really just illustrates what we're trying to articulate. We can see it in our economic surveys. I can't give you the figures because our manufacturing one is released at 11 this morning, but we know from across our other sectors, and it's so helpful when businesses do fill out those surveys because we can quantify some of the cash pressures that businesses are facing. And what we're finding is that, the really crunch time that we're seeing in retail, hospitality and leisure is now rippling through the supply chain. We've got manufacturers who've had to close their doors. We have all the distributors, the hauliers, the whole ecosystem of the economy is really affected. And so I think it speaks to one thing, just how important it is to get the banking system working and helping to support the real economy. And that's where everyone is just, slogging their guts out to make that work well. I think it also does speak to my mind around the grant system. And that's where, the government they're not backing a loan, they're actually giving some direct support to companies. And at the moment, that direct support through the local authorities is focused only on retail, hospitality and leisure. It's really about our high street shops. But I think the government does need to start thinking about some direct support across other sectors. Now, of course, if you make that universal available to everyone, that's expensive, for the government and ultimately for all of us as taxpayers. So you do need to target it at the companies that really need it, and that's a really hard problem for the government, but I think it's something we do need to think about, because loans are important, but for some businesses that may not be enough, and these are the difficult decisions that policymakers have to look at.
Yeah. Alex, we've had a few questions come in since Rain touched on that question of whether we can and should move to 100% guarantees on loans rather than 80%. I appreciate that's a decision for Treasury rather than for the Bank of England. But how should we think about the pros and cons of 80% versus 100%?
Well, as you say, it is very much a decision for the Treasury. And before answering specifically, I will go back to the fact that with an 80% guarantee, the government is leveraging up banks' capacity to lend 5 times to a number that's far in excess of what we might need, regardless of letter of the alphabet we end up talking about here. So I don't think the consideration is we need to increase the total amount available to lend. The considerations are pretty much as Rain lays out, and they center around, to my mind, very small companies where effectively the processing required per pound lent for a not fully guaranteed loan or something that's not a grant is very high. For larger businesses, of course, processing per pound lent is somewhat lower. And the question in the Treasury's mind will no doubt be, what do we get for the public money, taxpayer money, we would be spending here to effectively speed up processing for the small businesses? And those are the important considerations for them. I should say that it's often remarked that other countries have different systems. Some of them have 100% guarantees. I think there's been very close international cooperation amongst authorities in this crisis. We're all in the same position to some degree, and people do keep everyone else's schemes under close review to see what we can learn. Sometimes some of the what appears on the surface to be a no-brainer isn't quite such a no-brainer, but I'm sure the Treasury and we keep all those other schemes under close review.
Okay, we've got about 5 or 6 minutes to go on this, and I don't want to let both of you go without just touching on the much bigger picture, because I think both of you were at the Bank of England in the financial crisis 2008 and 9, and I'm interested. Let me start with you, Rain, and come to you later, Alex. How do you reflect on the scale of this, Rain, as compared with what you saw and what we went through back then?
So I think it's 2 things. I think, look, like the global financial crisis, what's happening now is hitting so many countries at the same time, and you know, the world is even more connected in a way than it was during the global financial crisis, and the role of China and Asia in the world economy is even more important. And actually, that's one bit that might help us, because as China and Asia emerges from this, and we know some of the supplies are coming back into the world system through China already, that will help to sort of insulate us. But it does mean that, you know, this kind of ricochets and is hitting all of us at the same time. I think what we also know, unfortunately, is I think the intensity of the impact on growth is going to be more severe in the very immediate. But I think what we hope is that over the long term, this should be, you know, we should come out of this quicker. What happened after the global financial crisis, and it was because it started in the banks and then ricocheted to the real economy, whereas what we're seeing now is an impact in the real economy, where we're seeing the banks step in to really help the real economy through that. Is that hopefully we won't see that really the dismal decade that we've seen over the past decade in the UK, where yes, employment has stayed strong, but productivity growth and people's standard of living have stagnated for so many people in real terms over the past few years. And I think what we are hoping is, if we get the policy right, if we can tackle obviously this virus and get our approach to the health crisis right, then we should come out of this relatively quickly, and that growth, when it returns, should be quite quick, and hopefully we won't see the scarring effect on living standards.
You mentioned China. I think the role that China plays is going to be really interesting, isn't it? Because actually 2008-9 in some senses wasn't as global an impact as this. China was largely out of the woods by 2009, wasn't it, and helped pull the rest of the global economy out. So China could be critical, couldn't it, in the future of this?
Yeah, and of course, one of the things that happened in China, there was a huge impact on global trade, and that really hit China because China is, you know, the sort of world's manufacturer and was then. But you know, the Chinese government was able to really, they went on an infrastructure boom, right? And they built things and they modernized China's economy in a speed and scale which we've never seen before. And so one of the questions is, how do they respond in the coming months? They still have a lot of, as economists say, fiscal firepower to help get that spending through. But you know, it's a challenging world, and they are going to be cautious as well about how this virus is tackled and how they come out of it as well. But I do think, interestingly, I think looking to that future piece, one of the things that I think we could see is what is the role of trade and services going forward? Because that may be one thing where we're all working from home, we're still able to do in a way, whereas I think physical goods, what we're seeing is it's a lot harder. So I think that kind of macro trend will be quite interesting, because that's a real opportunity for the UK. The sorts of things that China are interested in are the things we're naturally good at: financial services, health and education. Some of these things you can trade digitally when you are working from home.
Okay, Alex, let me come to you because, as it happens, I was noodling around on the Bank of England website yesterday afternoon, looking at one or two speeches that you'd given about speeches that you'd given about the fallout from 2008-9, and you spent a lot of time thinking about debt and the effect of indebtedness on the resilience of the economy and its ability to recover. We're looking around, seeing you know, possibly heading for a record peacetime deficit this year. Governments around the world racking up debt. How important will debt, pre-existing debt, and the debt that we now build up be in the next phase of this?
Well, I think, and to go to the comparison with the last crisis, it's very unfortunate, or deliberate but fortunate, that over the past 10 years, we've been, both as a private sector and a public sector, very prudent. Household debt is high, but interest rates are very low. Debt servicing burdens are very low for households. Same is true for the corporate sector as a whole. And as we well know, over 10 years, the government has been bringing down the deficit and stabilizing levels of public debt. All of that has put in place the conditions to actually borrow more, to do, as both Rain and I said at the outset, to bridge through this crisis, this public health crisis. You know, the path of the economy will be determined by public health decisions. Our job is to try and bridge through it, to try and make sure that on the other side, as Rain says, the level of output and employment is as close to where it would have otherwise been as possible, and we don't get the kind of dismal decade, as Rain put it, that we had after the financial crisis. So policymakers sometimes in this respect are very contrarian. We take away the punch bowl and tell people not to borrow when they want to. But right now, the message is the opposite. Credit, debt, they're actually a way to help us bridge through this crisis. And we're able to do that in both private and public sectors because of a degree of prudence over the decade building up to it. But if I may say one final thing, which is a big difference for me between this crisis and last, is the sheer intensity and rapidity of it. And actually, the last crisis has put us in a better position to respond. Oh, something's popped on the screen, which is that a lot of the tools we used back then are actually now in place. So we were able to set up a corporate bank in a week when the Treasury decided to set up the CCFF. And we were able to do it from people's front rooms and bedrooms. We've lent 13 billion already. We've signed up another 25 billion that people are free to borrow at any moment. We have 180 companies lined up as eligible, and we've done all that in a very short space of time. We've launched another asset purchase scheme in a very short space of time. So in a way, we are seeing a positive outcome from the last crisis, which is that the tools are there and in place and able to deal with the speed that we now have to deal with things.
Okay, well, that's a great note to end on. I think that thing that popped up on the screen was a warning to us that we're just about out of time. We hot off the press. We have found that on the webinar tomorrow, we have Annalise Dodds, the Shadow Chancellor, which is something to look forward to. So Alex, Rain, thank you all very much indeed. Thank you both. And thanks to everyone who sent in questions, and we'll see you tomorrow.
All right. Thank you.
Bye.
Thank you.